Welcome to the Going Long podcast. Our guest today is Mark Konyn, the Group Chief Investment Officer at AIA Group, the largest independent life insurer in Asia Pacific, overseeing investment portfolios across 18 markets in the region. Before joining AIA in 2015, he was CEO of Cathay Conning Asset Management and held senior roles at Allianz Global Investors, Fidelity, and Prudential. Mark, thank you so much for joining me today.
My pleasure. Thanks for the invitation.
Great. So you've spent much of your career investing across Asia, which of course is such a, it's almost hard to call it one thing. It's such a diverse place. From your vantage points, can you talk a little about what makes the region both so compelling and so complex for long-term investors right now? Can you sort of set the scene for us? There's so much going on.
Yeah, thanks, Sarah. It's a great way to start the conversation. I think many people coming to the region learn through experience that it's very diverse. You've got different financial systems, different legal systems, different cultures, different languages, different legacies, if you like, in terms of the history of how Economies has been built over time. And it's often convenient and maybe somewhat trite to try and create a common view of how the region operates. But there are some common themes which were popularized really in the 80s and early 90s, where you saw a number of economies remarkably go through a rapid period of industrialization and emerge on the global stage really as world-beating economies, both in terms of production, exports, but also domestic consumption, and leading the charge back then were the big economies, of which became big economies of Korea and Taiwan, joined by smaller city-states, Singapore and Hong Kong. And then as we got into the 90s, newly emerging economies across the region, which were more populous and industrious, and sort of threatened to become the next generation, if you like, of those roaring tigers to join the ranks of the industrialized nations. And this created a huge amount of excitement and enthusiasm for the region. And there were a number of papers that were published at the time by supranational organizations, international agencies, which tried to characterize what it was that was driving this remarkable growth. And it wasn't just the fact that, by global standards, these were countries and economies that were accelerating their growth. They were doing it in a remarkably short period of time. You had countries like Korea, which was going from the mid-70s, where they had no rice days, they didn't have sufficient food to feed the population, to the early 90s, where they were on the global stage as an industrialized nation with very, very significant world-beating industries. And they tried to characterize, many of these studies tried to characterize what was going on. And they came out with a few attributes, and underpinning, if you like, some of these theories was the fact that these countries had high savings rates. People were willing to defer consumption in order to build for the future. They were hugely productive. Productivity growth was enormous. Highly educated, a big commitment culturally to educating the next generation and investing in that. And then, strong centralized policies which directed strategic investment into key industries. So many of these attributes or characteristics were in common across the region. And I think that led us all to believe that Asia was somehow homogeneous and was on this long-term pathway, if you like, of emergence on the world stage. And I think since then, things have changed quite significantly. Each of those countries that I've mentioned, they each reach a stage where they mature, and then growth needs to moderate. Of course, nothing can grow a double-digit permanently. The big change, if you like, or the key change over this period was the emergence of the mainland Chinese economy entering WTO at the end of last century, which really propelled a hugely populous country, which emerged really out of poverty. So unlike the previous round of growth, if you like, as I've mentioned, China was in a very different situation, a lot of poverty and an aging population as well, and some very significant structural issues to address. But by coming into WTO, it basically became the production powerhouse, which we all know China became over that period, over the last 25 years. And so we'll put all this together, on the back of financial reform and the development of capital markets, you start to see some sort of strategic themes coming out. And as a life insurer, of course, what we're looking for are long-term opportunities to deploy capital. So we've worked very closely with the ministries of finance across the region, trying to develop bond markets and build out the rates curve in a number of economies, trying to deploy capital long-term, recycle capital. One of the things which we feel we do is mobilize domestic capital, then aggregate and then redeploy domestically to try and help build the infrastructure and the support and the networks that continued and sustainable economic growth requires. So if we look at it today, we still have relatively young populations in many of the jurisdictions where we operate across the region. So that you could pull out as a commonality. But at the same time, you also have a number of economies now which are sort of challenged, if you like, demographically, as the population has aged and the demographic profile has significantly adjusted over the last 35 years. So still very difficult to summarize and say to one region, it's a vast area, it's a significant proportion of the global population, as we know, is 24% of world GDP, but it's 35% of the growth of global GDP. So there's still plenty of opportunity, but I think it's now recognized to be much more diverse, and it's not a sort of one approach fits all, one size fits all. It's much more requiring a discerning need to go in and understand how each different economy, how each market operates, and understanding where the opportunities lie to deploy capital. So that's a long answer to a short question, but try to give you a flavor for how things are. I mean, companies that have been successful, we operate across 18 markets. Companies that have been successful really operate on a local level very often and understand the nuances of each and every jurisdiction, both from a regulatory point of view, but also importantly from a cultural point of view.
So when you think about, for example, like you said, taking the capital, so people buy life insurance policies, you accumulate that capital and then you reinvest it. Do you think of that as country by country, or how are you thinking about investing and how closely allied is the liability side and the asset side? In other words, are they 18 different ones, or is it one or somewhere in between?
Yeah, I work with a giant spreadsheet, basically. 18 different markets. It's one balance sheet. We're one company, but obviously 18 different sub-balance sheets, if you like, each with the local jurisdiction having its own rules and regulations, capital rules. So you're looking to optimize domestically, but deploy capital across the group on a universal basis. So the name of the game really is capital efficiency, and to maximize the returns once you've optimized for the deployment of the capital. So what does that mean? I mean, basically, when you write long-term insurance, as we know, you're setting up liabilities, which is effectively a commitment to pay back cash flows over a period of time. So one of the things we do very well is the planning and the underwriting. So by doing that well, what you create is more reliability and more certainty about the cash flows. But then you've still got to go out and match those cash flows. And as a long-term investor, you don't get rewarded for taking rates risk. So by closely managing your asset profile to match your cash flow profile, what you do is you reduce the sensitivity to rates risk. Therefore, you reduce the cost of your capital that you're deploying. And as a result, you can increase the return, because then you free up assets, if you like, to take risk on a prudent basis. But you take risk where you can afford to take that risk, subject to your risk budget and appetite. And then that extra return gets shared, depending on the types of policies you're writing, gets shared with the policyholders and with the shareholders. And that really improves for the shareholder. That improves the return on capital, of course, because you're more efficient in your deployment. And for the policyholders, where they're participating in the upside of those investment strategies, that improves the outcomes for them over the long term. So the alignment is there. You're trying to get as much capital efficiency into the book as possible. But I think, Sarah, as you say, it's a diverse region. It's 18 jurisdictions. Each has its own rules. Often, insurance authorities and finance and financial management domestically really pushes you towards investing back domestically in that economy anyway, because there are rules around how much you can invest overseas, under what conditions, and what types of investments you can bring in. So there's a bit of a tension there. What we're trying to do is help develop the domestic capital markets, but at the same time, of course, we want to grow the insurance market, because for long-term insurance, we believe very strongly that what it does is it liberates people. It helps them cope with certain risks that they'll encounter through their life. That if they can't manage those risks in a professional way, working with an insurance company like us, those risks become too daunting, and then they prevent people from then allocating their own savings productively because they become overwhelmed by the consideration of those risks. So typically what happens is, once an economy starts to emerge and people start to acquire some sort of financial stability, they then have something to protect, building a family, acquiring assets. They then need to be able to manage some of these risks that may occur as they move forward with their life. And that's where we come in. And it's recognized, I think, universally across the region. The first question was, how does the region work? I think one of the things that we can draw out from a way that the industry operates is there's general recognition that the private sector, private health insurance and private life insurance plays a critical role in helping people develop financial wellness, and as a result can help, if you like, propel the economy further forward, because once people are unencumbered by those risks, they can then get on and be productive. And there's wide recognition of that. So we tend to be reasonably well supported with the regulatory frameworks, but nevertheless, within the context of economic management and financial management, most of the assets typically stay onshore.
Okay, that's really helpful. That's very helpful to me. And then in terms of, yeah, I can see you're in Hong Kong from where you are. I know that is where you're based. Tell us.
Bank of China behind me, yes.
There we go. So I've heard this phrase recently a lot. Hong Kong is back. There's enthusiasm. Tell us what it feels like there now. What is the and how are you thinking about the Chinese economy, the Hong Kong economy? Does it feel like it's vibrant? How does it feel?
Well, Hong Kong's always vibrant. People are remarkable in this part of the world more generally, but in Hong Kong specifically, there's a constant striving to try things that are different, to entertain new ideas and to push forward. So, I've lived here 36 years. The economy has changed dramatically over that period, as you can imagine, and not least the skyline has also changed dramatically as the real estate market has continued to evolve. But the economy has dramatically changed in that period. When I first arrived in Hong Kong, it was very much an entrepot. It was, most of its business was re-exports out to Europe and to the US, and it was typically sort of adjusting its position to take advantage of quota systems for re-exports out of China. Of course, WTO changed all that when China entered WTO, and Hong Kong became, they are often called Hong Kong, the sort of middle liaison person between China and the rest of the world. So a lot of the sourcing for global goods and the quality control and the logistical management came through Hong Kong, built on its very advanced port facilities. Over time, of course, that's changed significantly because the infrastructure that sprung up along the eastern coast of China came to rival Hong Kong in some ways, but really was there to cope with the expanded scale of how China evolved and became the main production center for the global economy. So Hong Kong had a different role to play. I think the pandemic hit this part of the world extremely hard. As you know, the management that was chosen to help cope with that crisis was one of restriction. So both in mainland China and in Hong Kong, people were quite heavily restricted in terms of international travel. So that curtailed a lot of business opportunity here. People were restricted in terms of how they could go out and consume. In mainland China, it was even more significant. So the economy, in terms of domestic consumption of a traditional sense of what people were used to doing, changed dramatically. Coming out of the pandemic, of course, these economies have been very vibrant and have adjusted significantly. So we've seen a massive emergence of online consumerism, particularly led by China and the use of technology and logistical assets, of which we're a big investor in. So where does that leave Hong Kong today? Hong Kong is, and you said it well, that we often hear the phrase "Hong Kong is back." There's been a big push to support the economy and get the private sector running again. I've got some stats here for you. I've just printed them off from one of the broker reports that I review. As at the end of the third quarter, Hong Kong, so it's very current. We had a record of 289 IPO applications. And throughout the year, we've had 83 A-share companies have filed to list here in Hong Kong, which makes it the largest IPO market in the world this year, which is quite remarkable. If you think about, where we've been in the last 2 years, where we've had global commentators talk about China is uninvestable and the bifurcation of the global financial system and technology, all of these big sort of geopolitical considerations have really created a specter of concern, particularly when it comes to a financial hub, which fundamentally Hong Kong is, whether or not the financial system could sustain itself in the face of those tensions. And what we're seeing now is, the Chinese economy, second largest economy globally, is powering ahead. A lot of innovation, a lot of investment in key strategic sectors. And a lot of the benefit of that is now flowing back through Hong Kong. And this is one example of IPOs. Now, Hong Kong is set up as really a world-class business center with all the global services here. So to get business done effectively, efficiently, reliably, there is nothing to rival Hong Kong in serving these IPOs. And that's what's really pushing Hong Kong forward. At the same time, we've seen a resurgence in visitor arrivals. I think this year, we've seen tens of millions of people come back to Hong Kong. 24 million visitors arrived in the first half of this year. That's 12% up year on year. And we've seen even further expansion as we've gone through the third quarter. So very significant return of tourism, big return of financial activity. And as we speak this week, the Hong Kong Monetary Authority, which since the pandemic has been hosting an annual sort of conference where key figures globally from the financial services community come to Hong Kong and discuss critical issues of the day. That's taking place as we speak today, this evening for you, this morning for me. That's taking place. And all the good and the great globally are here. Firstly, it was designed to show support, obviously, for Hong Kong and the Hong Kong economy. But since then, it's become a key date within the global financial calendar, which again represents and is evidence that Hong Kong has a critical role to play as a key financial center globally, not just regionally and not just for China, but globally. And Hong Kong has maintained that position. So we're starting to see that re-energize, if you like, the community here. We've seen a resurgence in the expat community, and the nature of that has changed over time, but it continues to attract great talent internationally. A lot of young people from across the region can accelerate their careers by coming to Hong Kong. And at the same time, Hong Kong is emerging as a very significant educational hub where both people from the students from the mainland and internationally see Hong Kong as a great opportunity. And the Hong Kong universities here are world renowned and are investing in infrastructure and capability, bringing world-class lecturers back to Hong Kong. And we're seeing the educational community build at the same time that we've seen this resurgence in business activity and tourist activity. So, today there's still work to do, of course. Hong Kong, the Chinese economy is very, very significant in terms of its influence of how things work in Hong Kong. And in China, we still have the overhang of overproduction and overbuying of residential property. So that still has time to work through, which is suppressing consumer confidence to some degree. But nevertheless, what we're seeing now is a foundational build out of the key tenets of the economy. And that's starting to take shape and to be pushed forward by policy. And the innovation that we're seeing coming out of China, which is resulting in those IPOs, is really giving Hong Kong the catalyst it needs to move forward.
Yeah, that's really exciting times. So if we turn to China for a minute, you've mentioned several things that I wanted to touch on. One is the property issue, and there is some overhang there. I think the other is the innovation that's going on, whether that is robotics or AI or biotech or other things. And I'd be interested in your sort of, if you look fairly long term, you see some countervailing forces here, which is as you said before, China has become sort of the workshop of the world. But how does that change with robotics and AI? And then does that do we have sort of a two-tier economy, and how does the property work itself out? So paint us a picture of 5 years, 10 years. How do these trends come get resolved?
Yeah. So the it always amazes me that successively governments globally get surprised by demographic transition. And yet, if you look at the sort of the shape of demography in any one country or economy, it's highly predictable. You every
Yes.
year everyone gets a year older. So you can make adjustments for immigration, etc. But for most countries, most locations, it's extremely predictable, and longevity as well. Even though it's improved significantly, we can talk a little bit about that and the impact that's had on long-term savings and the allocation to capital markets. But these themes are highly predictable, and it's something that China has been acutely aware of. Many commentators have said that China got old before it got rich, whereas typically economies sort of mature at a certain pace where they create wealth, and then slowly the demography reflects that as family sizes get smaller and you get an aging population, much of what you're seeing in parts of Europe, etc. So China's been aware of this. So the key feature of economic management there really is to create social welfare and even out the creation of wealth. What that's meant historically is creating jobs, and obviously entering WTO and being the manufacturing center for the global economy creates a huge number of jobs, brought over 650 million people out of poverty within a generation. It's never occurred in the history of humanity on that scale. But they've been aware of the fact that as the demographic profile adjusts, there are a few things that need careful management. Historically, with lower longevity, the retirement age was too low. So getting people back into the workforce, but it's not just going back in and doing the same thing. So China has an ambition to move up, and has had for some time, to move up the value creation value chain and get out of the low-cost manufacturing as that offshores and seeks out cheaper sources of labor, and provide more value-added services in the economy to create that wealth. So these features have been prevalent for some time. And I think, what happened during the pandemic is the world became disconnected. And whereas you always had a significant amount of visitors from a business point of view going through the region, and particularly to mainland China, and understanding the changes, we had a hiatus of nearly 3+ years and beyond, because afterwards it's taken time for things to get back on an even keel. And some would argue with the political overhang and tension, it hasn't got back to where it was, back pre-2019. So a lot of that understanding and in-depth appreciation of economic development was lost. And it almost sounds ridiculous that within a short period of time, people can get out of touch. But 4 or 5 years is a very significant time in a high growth area, particularly when it's fueled by technology. So if you go to China today and you haven't been there for several years, 2, 3, 4 years or plus, you'll be quite surprised at the level of automation, and particularly in production, in port facilities, in logistics management, in the way that literally you can order goods in the morning and they're delivered before lunchtime. You can get fresh goods, fresh food delivered within 2 hours in the key city areas. The level of automation and the impact that's had on the demand for labor is profound, and that will continue. And at the same time, the level of investment in technology and in building skills to support the development of that industry through education and through people development has been really, really significant. And that's been a big shift. And I think we're going to continue to see that. So it's not so much now about creating more jobs. It's about creating value-added activities within the economy so that the wealth can continue to be evened out. Now, a big barrier to that has historically been, the way in which wealth transmits through the economy, and for a good number of years, over 10, maybe closer to 20 years, a key transmission of that wealth creation was the real estate market, the residential market, which, it's a very narrow economy in mainland China. It doesn't have the depth of instruments or financial capabilities that we see, particularly obviously compared to the US, but even elsewhere globally. So the dependency on a transmission of wealth through the residential real estate market and the interconnectedness that had with local funding for local governments created a sort of fulfilling cycle of capital being reapplied, which ultimately created oversupply, and we're still suffering from that. So if you look at the overhang of property in many economies globally, it can typically take 5, 6, 7 years to address that. I think what we're seeing in China, because of the scale of the structural overhang, it's probably going to take both a little longer, but it's also going to take a little bit more public policy. So ultimately, much of that overproduction, it's useful in the sense that it's needed, but how do you get it to the market at the right price and accessible? And the likelihood is a lot of that is going to be socialized and created and put in systems where it's made more accessible to a broader swathe of the population. And that potentially is very disruptive, of course, because a lot of resources have been tied up in that sector. So that in itself will take time. In the meantime, there's an estimate, there's something like $19 trillion equivalent of domestic savings locked up in the banking system, individual savings, which is an enormous amount of money, of which it's estimated somewhere around 6 or 7 trillion is accessible or is mobile to go out of the banking system and be applied to capital markets. What's suppressing that today, even despite a very strong performance of the domestic equity market over the last year or so, what's suppressing that is confidence, because the main savings destination for accumulated wealth over the last several years has been the domestic residential real estate market. And that's, if it hasn't gone down significantly, it's certainly not moving. So that overhang is suppressing investor confidence. And that's the big conundrum, if you like. That's the big issue that the authorities are facing, because as long as that money stays locked up effectively in the banking system, suppressing rates and not being lent out productively, it really is a drag on the economy, and it creates almost a paradox of thrift within the economy, where people get accustomed to saving more because they're getting low rates of return, and they're more comfortable with that level of really low level of risk taking, rather than being a little bit more forward looking and a little bit more growth orientated, so that they can generate more returns for retirement. So that's the piece that needs to occur. So what does that need? That needs financial mobilization and liberalization, and there are a number of initiatives underway as we speak now, which are pushing the boundaries of the current regulatory framework in order to get people to understand how to manage their finances and get more balance in their domestic savings, and hopefully through that make those savings sweat a little bit harder and be more productive. So within that context, life insurance has a big role to play, as do many other financial services. But life insurance, of course, has the unique aspects within the construct of when people sign their contract, they make a commitment over a very long period of time to fund their premiums, and that's unique within the financial system in this part of the world. If you look at the way mutual funds are sold and serviced across the region, and there's another characteristic which makes people think it's one region. The average holding period for a mutual fund, which is typically bought through a bank as opposed to an intermediary, the typical holding period is less than 6 months across the region, and that applies. It's pretty common wherever you go. And you could say it's mis-selling or it's structural, but it's a fact. That's how people think about buying risk assets and making commitments to savings plans. So in the face of that, where life insurance comes in, is making that long-term commitment, paying your premium regularly over multiple years, allows a more professional approach and creates an institutional pool of capital, which can then be applied to markets. And there's a huge amount that needs to be funded. Of course, we've got energy transition, we've got infrastructure, we've got adaptation, we've got communication networks, we've got logistics. There's a huge amount that needs to be funded from the private sector. And so it's a question really of connecting all of these pieces and making it more of a fluid approach so that people feel comfortable making those commitments, which can then be mobilized, aggregated, and applied to some of these very interesting investment opportunities. And there are many across the region. Near term, of course, the overhang of that property, it will be worked through, but we've got a little bit further to go before we can say that it's behind us.
Well, I think most countries around the world have had one of those property issues at some point in time. So can you, in terms of China, can you explain this Chinese concept we're hearing about involution and what that really means? And I will tell you, in the Western press, I see two sort of different things. One is sort of just turning inward, not worrying about the rest of the world. And then the other is this internal competition and trying to limit internal competition. How do you explain this word or this concept to people?
Yeah. I've heard similar explanations. I think it's less about turning inward. I think it's much more about creating strength within key industries and creating national champions, which it's not dissimilar to what we've seen in countries in Europe, where you've got a small number of key companies, big companies that dominate particular industries and become national champions, and then historically have gone on the world stage and have exported and used that to generate profitability on a global scale. And I think China has the same aspirations. It's got world-beating capabilities. It's got very innovative application of technologies in key strategic areas, particularly when it comes down to sustainability. Things like solar panels, we know they dominate the global market. EVs, batteries, a lot of the technology that drives these industries are at scale in China because of the nature of the economy and the commitment to these long-term goals, which means that China has an opportunity to provide the global economy with the technology that it needs to make that energy transition and to fulfill its sustainability goals, particularly when you think about the context of the emerging world. There's no way that you're going to go to emerging economies and they're going to be able to afford the sort of vehicles that you're going to get produced out of the US and Western Europe. The cost structure is just not attainable for an emerging economy, and yet the demand, you would argue quite strongly, is much more significant, because if these economies that are industrializing today go down the same path that we all went in the West of using fossil fuels, sustainability really gets set back quite significantly. So China has a real key role to play there because of its long-term investment in these technologies and its ability to produce these at scale and at low marginal cost. So that all sounds great, but when setting about doing that, the emphasis on creating these national champions has meant that firstly they compete for a very big market domestically, and then the theory has been that when they've become very successful, then they're fit and proper to go out and compete globally. And it's a great concept. It was something that the Japanese did very effectively during the 60s and 70s and then onto the 80s. And it's a proven pathway for getting national champions up and running. I think the difficulty that China's had because of the competition domestically and the rate of innovation with technology, you've ended up with new entrants in the market which have sought market share domestically and have reduced production costs to a point where they're selling goods at times below cost. And so that sort of chain that I've just outlined, that sort of narrative of creating domestic champions and then going international starts to break down, because if your domestic champions are operating on low margins and without profitability, they're not going to be in a fit state to then be profitable as they go offshore and start to explore other markets. So I think the Chinese government, which is still a centrally controlled economy, lest we forget, takes a look at that and thinks that this is not going exactly according to plan, that if Chinese companies continue to beat themselves up domestically to the point where they're not profitable, then it's going to become destructive and it's going to become a problem and an impediment to fulfilling that vision. So they've come up with this sort of anti-involution concept, which is an old concept. It's an economic buzzword. It's been around in China for several years, but it didn't start in China. And the idea there is to create disincentives for players in certain industries which are operating either at subscale or have a cost structure which is ultimately going to lead to not the right sort of profit profile for them to become national champions. So starting to put production caps and phased exits on certain companies, so stricter enforcement against below cost pricing and unfair competition. So many of the things that we've seen in other parts of the world, sort of preventing companies from operating with unfair competitive practices, but obviously on a scale and at pace, and promulgated in a different way, which creates a lot of attention internationally. But these are all sensible policies, and with the goal of improving profitability, stabilizing prices, and preventing, which is the key here, prolonged deflation. And at the same time, obviously not wanting to dampen down the innovative capacity within the economy. So fostering innovation, quality rather than quantity. I think that's the watchword. And if you look at the latest 15th five-year plan, these are very much the elements that are coming out very strongly to create quality rather than quantity, to create sustainability within the industries, but of course still with that ambition to be operating at a global scale. And I have a different view. I mean, I'm not politically motivated, but I look at the sustainability agenda that we have as an organization and that we believe in, because we operate at a community level with our policyholders, and we feel we have a responsibility to deploy capital in a way which is sustainable, not least because we can't suffer the risk of stranded assets if we're investing in industries which are going to be wrong-footed by climate change, for example, and sustainability issues. You're going to be left lending money to companies where their business model is going to be challenged, and your assets that you've helped fund could end up being stranded. And we've seen it already. We've seen early closure of certain energy facilities across the region, and debt cancellation, which ultimately means value destruction. So these are very serious issues that we face as a long-term investor. And if we look further out, how is the developing world, newly industrialized world, how are they going to cope with balancing out the need for growth and at the same time the need for sustainability? And without the technology and without the support of a very big sponsor who's producing the equipment and the transportation systems, telecommunication systems, etc., without that being available at an affordable price, we're going to end up still with a two-speed global economy, which is not good for sustainability. So these because then you end up just exporting the problem to somewhere else. So these are the issues you've got to balance out. So anti-involution, I've seen it characterized negatively internationally. I think it makes economically perfect sense. Whether or not it can be implemented in the way that's intended, time will tell. But certainly the philosophy, the narrative is correct.
Great. That's really helpful. And when you said this two-speed economy, the U.S. Secretary of the Treasury the other day talked about the U.S. and China economies decoupling. Are you seeing the real decoupling, or is this just the sort of back and forth of two large powers, sort of, who manage their economies differently, jostling for position over time?
Yeah, it is fascinating. And, when I came out to the region 36 years ago, China was a very, very small part of the global economy. It was less than 4%. Um, Hong Kong was a very significant part of the global export market and value chain. Of course, that's significantly reversed, and China is a powerhouse. So China has emerged economically strong and interestingly fully integrated into the global trade system. So which is a great innovation, because of that, the interdependency requires a balanced view on how policy is set internationally. So this tension that we're seeing now clearly is tension between two strategic economic rivals. And I think, as it was characterized at the recent summit in South Korea, there'll be times when, it's cyclical. There'll be times when rivals, there's a bit of friction, and there are other times where they seem to get on better. And I think that's how it's going to be for as long as we can forecast. Is it a decoupling? I don't believe so. I think the interdependency is too significant. I think the need for innovation is there. You are looking at potentially, two different technology approaches, a bifurcation in the application of technology, and time will tell to what extent that will continue. Certainly in terms of the financial system decoupling, I find it hard to see how that will occur in any time soon. The need to support global trade. What's interesting, if you look at some of the statistics this year, third quarter Chinese exports are up 9% quarter on quarter. Exports to the US collapsed by 27% from China. So, global trade is continuing. So we hear a lot about, the unwinding of the global trade system. Doesn't appear to be the case. We've still got, growing exports from this part of the world, or admittedly, the amount that's being imported into the US is significantly falling, but the world's a much bigger place. So I think, the financial system globally is well established. I don't think we're getting financial decoupling in the way that is being portrayed. I do believe that resiliency is much more important, whether you're a bank or an insurance company or a national entity. So, being less dependent on any one method of payments, being less dependent on any one provider for particular goods and services, friendshoring, all of these types of terms that we've seen evolve. The global economy needed to become a little bit more diversified. And I think that's the phase we're in now, trying to create that resiliency so you're not wholly dependent on a very narrow defined value chain and supply chain. It's something that we all witnessed during the Fukushima nuclear reactor disaster, where suddenly we realized that we were wholly dependent on a small number of producers in a narrowly defined part of the world for components which affected significant industries internationally. And I think since then, resiliency has become much more part of corporate planning. Necessarily increases costs, and that's where we all are at the moment, trying to optimize the way in which we take in services, and that we create stability and diversification in the way that we conduct business. And I think, the region as a whole has a significant part to play there. We've talked a lot about China, of course, because it's the dominant economy, the dominant power globally and certainly in the region. But the workforce across the region is highly productive. There's capacity in countries like Vietnam or the Philippines or Malaysia or Indonesia or Thailand. These are all, highly productive workforces that have very good connectivity internationally, both to the West and with China. We've seen a lot of offshoring with production capability going into these economies, which lifts these economies. At the same time, we've seen longevity increase quite significantly within a generation, which is creating demand for more financial services. So we're seeing the evolution of the service sector come alongside the industrial base. So these are all good developments which create wealth, bring people out of poverty, help support education, and create economic outcomes and economic activity, which ultimately creates more stable societies and fairer societies.
Well, I mean, it's an exciting time. There's so much change. So last question for you, looking, put your really long-term mindset on 10 to 15 years. What do you think? Is there something that people are underestimating? We come back and have this conversation in 10 to 15 years. What will it be that the broader market has underappreciated today? What's the long-term trend or surprise that catches up with us?
Well, there are many unknowns, so it's a really important question. When you work in a life insurance company, of course, 10 to 15 years is not a long time.
You're right.
That's a typical planning cycle. But I think the use of technology and the impact that it's going to have on people's lives, and the advances that we're seeing in this part of the world, and the readiness to apply that technology, and the flexibility and nimbleness to inculcate and embed it inside the industrial complex and inside the economy, the way it functions. These are things which give, I think, many of the economies in this region a significant advantage, because we're starting from a newer standing position. A lot of the economic development has taken place in the last several decades, so it doesn't have the same legacy that's there. It doesn't get encumbered by the same cultural way of operating. The strive for newness and the ability to turn away from something which is not as productive as it might be, and to embrace something new. It's the readiness to do that is far more prescient. And I think, if you let the clock run forward, very quickly you're going to see the adoption of those technologies and the implications that it has economically on the next generation. And that can be in production, it can be in consumption, but I think importantly it's going to be in financial services as well. Digital finance is going to be fully embraced by the current generation, and the way that we all operate as financial services companies, I think potentially, but probably definitely, is going to change in a way which will surprise us. You and I come back on this call in 5 years' time, let alone 10 or 15. I think we'll have a lot to comment on what we've observed and all the things that we hadn't anticipated. And you're starting to see it in the way that people consume. You're starting to see it in the way that people manage their personal financial situation, the way they engage with service providers, the use of AI, very significant, agentive AI, in guiding people into how to interact with professional services. These are all, in this part of the world, they're liberating, because they're not disruptive potentially in the same way they are in well-established financial systems, where there's a large installed base which feels threatened by some of these innovations. In this part of the world, it's a necessity, getting everybody a mobile phone so they can interact and have online banking, and can then have access to services which they need in order to move up in terms of the wealth sort of pyramid, so that they can enjoy higher standards of living and participate more in the economy as a result. These are necessities in many of the economies in this part of the world. So you're less restrained or constrained in terms of ability to adopt. And I think that's what's going to surprise. And, I would encourage people, if you're not sure, if you think I've been taking the Kool-Aid, come out. It's very easy to get a visa in this part of the world to visit anywhere you like. These are open societies. You can go and visit. You can visit places, see how people are embracing technology from a financial services point of view. You can observe firsthand in places like China, where there's very little cash in circulation. Most transactions are e-transactions. It's small purchases, all purchases in restaurants, taxis, buses, you name it. There's, if you can't, you need to operate outside of historical norms. You can't operate the same way. So this will layer on, and it will build and build very quickly. The level of adoption is very significant. So I would say that's the biggest change. What does that mean for a business? You've got to be sensitive to it. You've got to be forward looking. You don't need to be necessarily a leader, but it means you've got to be agile. You've got to make sure the way you process your business has flex in it, so that you can adapt quickly as these behaviors, and it is behavioral at the end of the day, as these behaviors change and impact the way services are provided.
Well, it's a really exciting time, and it's the speed is remarkable. Every time I'm in Hong Kong, I'm like, wow, this is really different than the last time I was here. It wasn't that long before. So it's and other places in Asia as well. But it's terrific to get your insight. I appreciate your long-term view on this. Not many people say 10 to 15 years is a normal planning cycle.
Yes.
And I'm in the investment world. And so thank you for your insight. Thank you for what you were doing there. Thank you for your support of FCLT Global. I really appreciate it.
Thank you, and thanks for spending the time with me. I've very much enjoyed the conversation, and I'd encourage, next time you're here, we'll just pop across the border. The Greater Bay Area is a big theme for Hong Kong, the integration of Hong Kong with parts of southern China. You'll see the rapid changes that have occurred in just the last few years. It truly is remarkable, and it's something you can't see necessarily in many parts of the world. The rate of change it is surprising, and I look forward to coming back in 5 years and sharing observations on how those changes have continued.
All right, I'll take you up on both of those things. Thank you.
Take care. Bye.
Bye.